Welcome back to our risk management seminars for 2021. We're here with Randy Barkley from Rain and Hail to give us an update on some of the changes that have happened with the multi-peril crop insurance program and some of the things that you need to be aware of for the 2021 crop year. Randy, thanks for being with us.
My pleasure, Alan. Glad to be here today. Join you.
So, Randy, we're going to just kind of talk about another option that is available, and that's called supplemental coverage option. So you want to tell us a little bit about that?
You bet. So the supplemental coverage option was first introduced in the crop year 2015. It didn't get a lot of attention then because I would tell you if we go back to that time, at least in this part of this part of the Corn Belt, many producers were electing. So within their farm program choices, they were electing ARC or area revenue coverage, and that disqualified them or meant that they couldn't elect supplemental coverage option because effectively those two cover about the same range of coverage, even though they work a little differently, they cover the same range. So the supplemental coverage option is it's an endorsement that provides additional coverage for a portion of the underlying crop insurance policy. It's designed to pair up with a plan of coverage that's part of what we would characterize as the common crop insurance policy. That means yield protection, revenue protection, harvest price exclusion, or one of the APH plans. It's got a really high subsidy level. In fact, SCO is subsidized at 65%, so that's some additional benefit. It's because it's an endorsement to the underlying policy, not a standalone coverage, it would be added to the policy by the producer by the crop's applicable sales closing date. So for corn and soybean purposes in our part of the world, we would be talking about March 15th. So as we move closer to that date, growers will have to make a decision if they're not electing the ARC County program as the farm program choice, they have an opportunity to add some additional coverage that in effect provides some coverage for the deductible portion above their underlying policy.
Yeah, so can you give us just a brief overview of what SCO is?
Yeah, so know that the supplemental coverage option follows that of the underlying policy, meaning that if they choose yield protection, then SCO or the endorsement functions as a yield loss endorsement. If it's revenue protection, of course, then it covers revenue loss. This is triggered at what I often characterize as the macro level, but it's the county level. It's an area-based plan of coverage. So what's important to understand is that the supplemental coverage option doesn't provide coverage based on that of the underlying policy. And what I mean by that is it doesn't trigger based on the producer's own experience. In other words, if the producer has low yields, but the county does not, then there may be no indemnity or loss payment that's provided as a benefit. It will trigger again at the county level. So, however, the amount of liability or the dollar amount of coverage, do know that is based on the underlying policy. So in other words, the grower's experience based on their approved yield. So it's based on their expected revenue of their policy. So your local crop insurance or your Rain and Hail agent can help you understand that. So again, it does pay on an area basis. The endorsement begins to pay when the county average falls below. In this case, if we're going to endorse the revenue protection policy, it will pay when the final county revenue falls below 86% of its expected level. And then the bottom of this coverage band is designed to go down and greet wherever the underlying leaves off. So for example, if the underlying policy is, say, 75%, the SCO will cover an 11% band of coverage, again, albeit at the area level. Or if, let's say, it's an 80% underlying revenue protection policy, that band, of course, would be 6%. Some additional points that the producer may want to take into consideration is know that payments with the SCO endorsement generally do occur later than that of the individual policy. Because this is based on county data, and we still have to wait on the final results we have to wait on the final county revenue or final area revenue. That means we need both the harvest price, which is incidentally discovered at the same time as their revenue protection policy. So for producers in Ohio, that would mean that corn and soybeans would have a harvest price discovery during the month of October, just like they're used to or accustomed to with their underlying revenue policy. But we still need the final county yield. And that final county yield is published by the risk management agency, and we won't have that data until about June 16th of the year that follows. But that can also be a benefit, right, Alan, because what that does for us is it may, if there is a loss or it triggers a loss, it may provide some additional revenue, at a time where we wouldn't customarily see that. It's also important to know, again, that the election be made by sales closing that I mentioned earlier, coming up here on March 15th, and that in addition to some premium, which I mentioned earlier was subsidized at 65%, there is the addition of an administrative fee, which they're also accustomed to with their underlying policy. That's $30 per crop per county. And then just like on their endorsements or coverage, it's a continuous and remains in effect until it's canceled. So they would have an option from year to year to remove that by March 15th. But if no action is taken once it's added, then it just continues on from year to year.
Well, there again with SCO, it's a simpler product, but it's always helpful to maybe have a visual to understand how it works.
You bet. So the visual that we're looking at provides an example whereby the underlying or the revenue protection policy, we'll say in this example, is 75%. So what you see in the illustration is from 0 up to 100%, 100% representing the expected revenue. And the expected revenue would be the yield. In the case of the individual or the revenue protection policy, it would be the approved yield on the policy, or what else characterizes the producer's experience. And then you see a chart with the heading area-based loss. Again, remember this triggers at the county level. So you'll see that this, again, doesn't provide coverage from 86 all the way to 0 or down to 0. It's just a band of coverage that's designed to supplement or complement that of the underlying. So the top of the band, in this case, is fixed at 86%. So we'll take the expected or target county yield, if you will, times the projected price, which is discovered in the month of February. Now, that gets us to the expected revenue, yield times price. With a supplemental coverage option, again, since we're using the area or county yield, we're going to multiply that area-based expected revenue times 86%. If the final harvest yield times the final harvest price falls below 86%, then it triggers a loss payment. However, if the county in this example were to fall below 75%, the final falls below 75%, then there's no additional payment. It's exhausted the liability, and then the individual or underlying policy, as we'd characterize it, would actually pick up any additional losses.
We've talked about, obviously enhanced coverage option. We've talked about supplemental coverage option, right? And so there's another piece that's a change, and that's the quality loss option. So you want to just kind of talk about that and give us a quick overview of what that does.
You bet. So the quality loss option was first introduced in this past fall. It was available to area producers to add as an option to their policy for wheat. And what it's designed to do, just simply, is it's designed to, I'm going to say, restore yields to actual when they've been adjusted for quality-associated losses.
Yeah, so what crops are available for that option, Randy?
Yeah, here you're seeing a list of the crops for which the quality loss option is available. So you have an opportunity to add this option to both corn and soybean policies, again, by March 15th, because any coverage elections or changes are required to be executed or implemented or added, if you will, by that March 15th sales closing date. But here we see a number of crops, but again, more importantly, since we are focused on spring crops at this time, corn and soybean.
What's the availability?
So in order to be available, it's first important to understand that it has to be available for that crop in that particular county. So we look to the actuarials, meaning that, again, it must be available for that county. And if it's listed there, then it's available for that crop and county. What I will tell you is that it's widely available across our part of the world for corn and soybean. It's also important to know that it's not an available option for the catastrophic coverage. So for those who might elect CAT, which is not popular these days, but if someone were electing CAT coverage, just the absolute bare minimum, it's important to know that CAT endorsements don't allow for any further elections. It's just a very basic plan and doesn't allow for any options. Do know that it can also be packaged with other valuable options that are part of the policy, or that can be added to the policy. For example, the trend-adjusted APH option, the yield adjustment option, the yield cup option, and the yield exclusion option. So many of these options are already added to policies. The latter of the three, the yield adjustment, yield cup, and yield exclusion, are all designed to be protections, if you will, to the approved yield. Your crop insurance agent can provide some additional perspective on exactly what those mean if you have questions about them. But this will pair with those, and again, can be added with that option package or with those other options. Do know that it has to be added. It also is applicable to prior crop years or any. So, for example, in that database or that unit, that all those historical yields, if this option is added in 2021, if there are any quality adjusted yields in that historical database, they may be eligible for a benefit from the quality loss option. There's only a premium cost if there was a benefit. So understand that, much like many of those options, in fact, all of the options that we just mentioned a moment ago, there's only a cost associated with the options, again, when there is a benefit that's derived from them. So your Rain and Hail crop insurance agent can help you understand more about how that works.
Well, so when we're talking about quality loss adjustment, what does that actually mean?
Great question.
What types of quality does it cover?
You bet. Great question, because many producers may not realize or understand that the policy includes coverage or protection for a number of items that are quality associated. For example, we see in our illustration here, for example, test weight or damaged grain. I'm going to look to the top left where you see injurious to humans or animals. That's referring to mycotoxins. There's actually coverage for several different mycotoxins included in the policy. Some of those that we're most familiar with would include vomitoxin, for which we've had some experience with that this more recent crop year in 2020 across many parts of Ohio, particularly southern and south. And if there was a vomitoxin loss, or if the producer had vomitoxin, it's possible that losses associated with that may be covered. If there were losses, if a loss notice was filed, and the way losses are calculated is there is an adjustment to the production to count. Another way, just for simple math, let's say that we've delivered or sold a total of 1,000 bushels of corn. And we've had vomitoxin that qualifies us for a loss. In other words, in order to be eligible for vomitoxin loss, we have to have a confirmed test for the USDA lab that's at least 5.1 parts per million or greater. If that's the case, then that production to count, even though the producer may have sold 1,000 bushels, was adjusted accordingly with the data or the information that's in the chart. So that results in a smaller or a lesser yield. And so that's how, if the yield falls below that of the guarantee for the unit, then there's a payable loss. So again, these are the types of, but all those items listed on the screen are those that are for which the quality loss may potentially benefit.
So what are just real quick, when do you have to select the quality loss adjustment option, Randy?
So we're coming up on those. We're in that mindset today, right? We're thinking about crop insurance today, and the elections that we're making are going to have an impact on our 2021 crop year. So we have to make the election or add the option by the sales closing date. Know that it's electable on a crop by county basis. So for those producers who are farming in a particular county, if they would like to have that benefit on both their corn and soybean crops, we would add it to each if it's available, which again generally is available widely in our part of the world for both crops. It's applied on an APH database by database basis by crop year. And so that's there's actually an opportunity. Your Rain and Hail agent has reports that can help them understand what that benefit looks like and the years that may have been affected. And then, like other options endorsements of the policy, it is a continuous election, which once added by sales closing will continue unless a change is made to the policy in the succeeding crop year.
Well, can you give us a couple of examples of actually how the claim works? Because the visual thing is a lot better.
You bet. Well, we're going to first know that the candidates for a quality loss option is really anyone. basically everyone can benefit. If there's particularly those for whom if they have a quality loss or have a quality issue in one of their databases, then they're particularly a great candidate. But any of those who might have a quality issue in the future. So know that basically anyone can benefit from the option. So let's see an example how that might work. So here are some actual yields represented by our wagons. In this case, we have 5 actual years of production history in the database, going back to the crop year 2016. And you see the yields accordingly for each of those respective years. So in crop years 2018 and 2020, there was a quality adjustment that occurred. May have been due to vomitoxin or any one of the other issues that we saw in the previous slide for which quality protection or quality adjustments are made. In this case, our 2018 production, while our producer sold 100 bushels, because of a quality associated loss, that production account was adjusted to 30. In 2020, the actual yield was 90, but adjusted down to 60 for purposes of a quality adjustment. So how that looks in a database or a unit on their crop insurance policy is like we see on the screen. You'll see, again, each of our respective years. I mentioned that we have 5 years of history in the database. And you'll see a couple columns on the right. The first one in the center is our pre-quality. PPC stands for production account. So just crop insurance terminology. And you'll see, again, the 2018 and 2020 years are 100 bushels and 90 bushels, respectively. Then when we see the post-quality production account for those respective years, it's 30 and 60. So there were adjustments that took place, and there may have been claims as a result, presumably so. There may have been claims paid on those 2018 and 19 years. So prior to 2021 and this new option that's available, those yields, the 30 and the 60 respectively, would be used for purposes of determining the producer's approved yield or their average. You can see at the bottom of the post-quality production account, we have a simple average of 80 bushels per acre, and the pre-qual, whereby the pre-qual is 100 bushels per acre. So again, if the new quality loss option is added, it restore those yields back to the pre-quality production account. The benefit is we've had an improvement of 20 bushels per acre in our average yield, which will have a considerable benefit in dollars insured or protected in the next crop year. So talk to your Rain and Hail crop insurance agent by the sales closing date of March 15th and better understand whether this will benefit you. But know that, again, if there is no benefit, there's no cost associated with electing the option.
Randy, thanks for being with us. And if you want to learn more about this product, give us a call here at the office. Stop in at any one of our 3 locations and talk to Denver or I. Be tuning back in because we're going to have more information and updates as it relates to risk management and multi-peril crop insurance changes. Thanks for being with us, Randy.
My pleasure.